Quick question to start with. If someone told you just wait 5 years and it's all tax-free, would you assume that's one single countdown for the whole account? Most people would, and for one part of a Roth IRA, that's actually close to true. For another part, it's a completely different clock, one that can restart multiple times, on different dates, without anyone telling you. Mira is 44 now, about a year after she first discovered the unlocked drawer in her Roth IRA. This year, she did something new. She rolled over an old 401k from a job she'd left a decade ago and converted $15,000 of it directly into her Roth IRA. And that single decision quietly started a second clock running inside an account that already had one ticking for years. Nothing about the conversion itself was unusual. Consolidating an old 401k into a Roth IRA is a completely ordinary move. Plenty of people do exactly this at some point. What's less ordinary is understanding what actually happens to that money once it lands inside an account that's already been open for over a decade. Most people, reasonably, assume the money just joins everything else already in there. One pool, one set of rules, whatever's already been established for the account applies to the new money too. That assumption is wrong, and it's wrong in a specific, predictable way that's worth understanding before it matters, not after. My name is Nick, and I spend a probably unhealthy amount of time thinking about money. Last episode, we talked about the bottom drawer of a Roth IRA, contributions, always accessible, no lock at all. Today's episode is about the two drawers sitting above it, because they don't share a single rulebook the way people assume it. This one is a little more mechanical than usual, but I think once you see how the two buckets actually work, one specific and very common mistake becomes obvious and avoidable. Here's the assumption that trips people up, and it's an easy one to make. People hear the 5-year rule mentioned once, usually in passing, and assume it means one clock, started once, covering the whole account forever after. It doesn't. A Roth IRA actually runs two separate 5-year clocks, for two separate purposes, and they don't start on the same date. One of them started years ago and never restarts. The other one can start over, again and again, every single time money moves into the account a certain way. This isn't a rare edge case, either. Rolling over an old employer account, consolidating multiple retirement accounts after a job change, moving money as part of a broader tax strategy, all of these involve conversions, and all of them start a fresh clock, regardless of how long the receiving account has existed. Let's go back to the cabinet last time. Bottom drawer, contributions, no lock, already covered. The middle drawer holds conversions, money moved in from a separate retirement account, like Mira's old 401k. The top drawer holds earnings, the growth the account produces on its own. Here's the part that catches people. The top drawer, earnings, is governed by one master clock. It started on January 1st of the year Mira made her very first Roth contribution, years ago, and it never restarts. Once that single clock hits 5 years, and Mira is 59 and a half or older, her earnings come out completely tax-free. The middle drawer works completely differently. Every single conversion gets its own 5-year clock, starting on January 1st of the year that specific conversion happened, not the year the account was opened. Mira's $15,000 conversion this year didn't inherit the age of her account. It started counting from zero. So right now, Mira technically has two clocks running at once inside the exact same account. Her account-wide earnings clock, which finished years ago, and a brand new conversion clock, attached specifically to this $15,000, that won't finish until 5 years from January of this year. If Mira assumed my account is old, so everything it is seasoned, she'd be wrong about that $15,000, specifically. It doesn't matter how long the account itself has existed. What matters is how long that specific conversion has been sitting there. Let's make this concrete with a slightly different scenario, because I think it clarifies the mechanism. Say Mira converts another $10,000 2 years from now, from a different old account she still has sitting around. At that point, she'd have 3 different clocks worth tracking inside the exact same Roth IRA. The original earnings clock, long since finished, the first conversions clock, partway through its 5 years, and a brand new second conversion clock, just getting started. 3 buckets of money, 3 different timelines, one account statement showing a single total balance that doesn't distinguish between any of them on the surface. That last part is worth sitting with for a second. The account statement itself typically won't spell out which dollars are contributions, which are conversions, and which are earnings, let alone which conversion belongs to which year. That information exists, and it's tracked by the custodian and reportable through tax forms, but it isn't usually presented back to you in a way that makes the distinction obvious at a glance. You have to know how to go looking for it, or keep your own record, the way Mira eventually did. Now here's the question this naturally raises. Okay, so what actually happens if Mira pulls that $15,000 out early, before its own 5 years are up? The answer isn't as scary as it might sound, but it's specific and worth understanding precisely, rather than guessing. Here's the part that's actually reassuring. Once you separate it from the earnings bucket, which people often lump it in with, Mira already paid income tax on that $15,000 the year she converted it. That's the whole point of a conversion. So, if she withdrew it before her personal 5-year conversion clock finished, she wouldn't owe income tax on it again. What she could owe, specifically, is a 10% early withdrawal penalty on that amount, not because it's untaxed, but because the IRS uses the 5-year holding period to discourage using conversions as a short-term workaround for early retirement account access. Richard Thaler's work on mental accounting applies almost perfectly here. People naturally treat all the money inside one account as a single mental bucket, my Roth money, even when the IRS is quietly treating it as several distinct buckets with different rules underneath. That mismatch between how the money feels and how it's actually categorized is exactly where mistakes like this happen. And this is precisely the mix-up that catches people. Someone converts money, waits for what feels like plenty of time, sees their account as old and established, and assumes everything inside it is equally seasoned. The account's age and the conversion's age are two completely different numbers, and only one of them is actually relevant to that specific withdrawal. Here's a version of the same mistake that runs in the other direction, and it's worth naming too. Someone who's made several conversions over several different years might assume the oldest conversion protects the newest one, that once any part of the account clears 5 years, the whole account is safe. It isn't. Each conversion is tracked on its own, individually, regardless of how many other conversions have already cleared in their own 5 years. Have you ever assumed a rule applied to the account as a whole, only to find out later it actually applied to one specific piece of it? This is exactly that pattern, just inside a Roth IRA specifically. Mira's system for this, once her planner explained it, turned out to be almost embarrassingly simple. She keeps one line in her notebook for every conversion she ever makes, the amount and the exact date, not because she plans to touch any of it early, just so that if life ever forces an early withdrawal, she knows immediately which dollars fully seasoned and which ones are still running their own clock. It isn't a spreadsheet. It isn't complicated. It's one line, added once, whenever a conversion happens, the same instinct that's carrying her notebook through every season of this channel, just pointed at a slightly different problem this time. The habit matters more than the tool. A phone note, a spreadsheet, a physical notebook, none of that changes the underlying rule. What matters is simply writing the date down at the moment the conversion happens, while it's easy to remember, instead of trying to reconstruct it years later from statements and memory. This is also, quietly, the same principle behind why this channel keeps coming back to notebooks and simple written records, season after season. Not because writing things down is magic. Because the moment something happens is always the easiest moment to record it accurately, and the hardest moment to reconstruct later is exactly when you'd actually need the information. So, back to those 2 jars from the beginning, 2 buckets, 2 clocks, sitting inside the exact same account, quietly running at different speeds. The mistake isn't misunderstanding the rule entirely. It's assuming an account's overall age tells you everything you need to know about every dollar inside it. It doesn't. Some of those dollars are exactly as old as the account. Some of them started their own countdown far more recently. Mira's $15,000 will finish its own clock in a few years, sitting quietly, doing exactly what it's supposed to do. She's not in any hurry to touch it, but she knows, specifically, when it finishes, instead of assuming. That's really the entire shift this episode is about. Not a new strategy, not a warning. Just replacing an assumption. The account is old, so everything in it is fine, with something more precise. Knowing which drawer a given dollar actually sits in, and which clock applies to it specifically. Here's something Mira does before she ever acts on a number like the ones in this video. She calls someone whose job is to check it, a CPA, a tax professional, someone who actually knows her specific situation, including every conversion she's ever made and exactly when. Not because the math here is wrong, because her life has detailed a video never could. If you take one habit from this channel today, take that one. Before you move a single dollar based on anything you just heard, verify it with a qualified professional first. That's not caution. That's just how the machine gets built correctly. So, I want to ask you something. Before today, did you know a Roth IRA could have more than one 5-year clock running inside it at the same time? Drop it in the comments. I read every one. And if this was useful, subscribe. Because next time, we look at the third piece of this, a specific starting line most people never actually track, and why knowing exactly when it started can matter more than almost anything else in this account. I'll see you there.